Hey there, future real estate professionals. Welcome back to the channel. Today we're diving into Chapter 8 of the UBC Real Estate course, Financial Statements. I've got 55 practice questions lined up to help you get a solid grasp on all the key concepts. Whether you're preparing for the exam or just looking to review, these questions will help you master the material and boost your confidence. So, grab your notes, get ready to test your knowledge, and let's jump right into it.
Question 1. Which one of the following best describes shareholders' equity? Correct answer. Share capital plus retained earnings. Explanation. Shareholders' equity represents the owner's residual interest in the company's assets after liabilities are deducted. It consists of two primary components: share capital, funds raised through issuing shares to shareholders; retained earnings, accumulated profits not distributed as dividends but reinvested in the company. Breakdown of other options. B. Retained earnings plus dividends. Incorrect. Dividends are distributions from retained earnings, not an addition to equity. C. Share capital plus retained earnings plus dividends. Incorrect. Dividends reduce retained earnings and are not part of equity. D. Net income less dividends. Incorrect. This calculation gives the change in retained earnings for a period, not total shareholders' equity. Question 2. Which of the following statements is true? Correct answer. B. Both sole proprietors and partners must report business income on their personal tax returns. Explanation. Both sole proprietors and partners report their share of business income on their personal tax returns. Sole proprietorships and partnerships are not separate legal entities for tax purposes, so income passes through to the individuals. Breakdown of other options. A. Only sole proprietors need to report business income on their personal income tax returns. Incorrect. Partners in partnerships must also report their share of the business income. C. Sole proprietorships, partnerships, and corporations are identical in terms of taxation of owner's income. Incorrect. Corporations are separate legal entities and taxed differently than sole proprietors and partners. D. A sole proprietorship is a business enterprise owned by a group of individuals. Incorrect. A sole proprietorship is owned and operated by a single individual. Question 3. Which one of the following will not be found on the balance sheet of a corporation? Correct answer. C. Names of the corporation's shareholders. Explanation. The balance sheet presents the financial position of a corporation, including assets, liabilities, and shareholders' equity. While it provides details about the financial state of the corporation, it does not list personal information like the names of shareholders. Breakdown of other options. A. Number of shares issued, found in the shareholders' equity section under share capital. B. Original cost of the property owned by the corporation, found under assets, as property is recorded at its original cost. D. Retained earnings to date, found in the equity section as accumulated profits not distributed as dividends. Question 4. Which of the following options is the generally accepted accounting principle that holds that all accounting information should be reported on objectively determined and verifiable data? Correct answer. D. Objectivity principle. Explanation. The objectivity principle requires that all financial information is based on verifiable and reliable data, ensuring accuracy and impartiality in financial reporting. Breakdown of other options. A. Consistency principle. Incorrect. This principle ensures that accounting methods are applied consistently over time, but it doesn't address verifiability. B. Verification principle. Incorrect. While related to verification, this is not an officially recognized principle under GAAP. C. Materiality principle. Incorrect. This principle focuses on the significance of financial information and its impact on decisions, not on verifiable data. Question 5. Which one of the following transactions does not affect the amount of owner's equity? Correct answer. D. Purchase of assets by the business. Explanation. The purchase of assets by the business does not affect owner's equity as it only changes the composition of the company's assets, e.g., cash decreases while another asset increases, but does not impact the overall equity. Breakdown of other options. Investments by the owner. Incorrect. Investments increase owner's equity as they add funds or assets to the business. B. Personal withdrawals from the business. Incorrect. Withdrawals decrease owner's equity as funds are taken out for personal use. C. Net income earned. Incorrect. Net income increases owner's equity as it represents the business's profit. Question 6. Which of the following statements regarding a common shareholder of a corporation is true? Correct answer, D. They are liable only for the value of the shares purchased or agreed to be purchased. Explanation. Common shareholders have limited liability, meaning they are only responsible for the value of the shares they have purchased or agreed to purchase. They cannot be held personally liable for the corporation's debts beyond their investment in the company. Breakdown of other options. A. They do not have the right to elect the board of directors. Incorrect. Common shareholders do have the right to elect the board of directors, who oversee corporate management. B. They share directly in the income of the company. Incorrect. Shareholders receive dividends, not a direct share in the company's income. They are not permitted to receive dividends. Incorrect. Common shareholders are entitled to dividends when declared by the corporation, although they are paid after preferred shareholders.
Question 7. Fannie Mac Limited purchased a small commercial building for $225,000, of which $100,000 was the value of the land. If at the time of purchase, the expected economic life of the building was 10 years, there was an estimated salvage value of $25,000 at the end of that time, and Fannie uses the straight-line depreciation method. What is the depreciation expense for the year? Correct answer, B, $12,500. Explanation. Depreciation expense is calculated using the straight-line method with the following formula. Depreciation expense equals to cost of the asset minus salvage value, divided by useful life. Step 1. Let's determine the depreciable value. Total purchase price of the building equals $225,000. Value of the land equals $100,000. Land is not depreciated. Cost of the building equals to $225,000 minus $100,000 equals to $125,000. Salvage value equals to $25,000. Step 2. Let's calculate depreciation expense. Depreciation expense equals to $125,000 minus $25,000 divided by 10, which is to $100,000 divided by 10, which equals to $12,500. So the correct answer is $12,500. Question 8. Max Smith runs a small grocery store. The balance sheet as of March 31st, 20XX shows land of $180,000 and building of $72,000 under the asset column. He bought the land and building exactly 3 years prior to this statement's date. Each year, Max claimed 5% depreciation expense. What was the purchase price of the land? Correct answer, A, $208,373. Explanation. The problem involves separating the purchase price of the land from the building's cost, accounting for depreciation over 3 years. Step 1. Let's determine the original cost of the building. The current building value is $72,000. Annual depreciation equals to 5% of the original building cost. Over 3 years, total depreciation equals to 15% of the original building cost. Let X be the original building cost. X minus 0.15 times X equals to 72,000. 0.85X equals to 72,000. Therefore, X equals to 72,000 divided by 0.85, which equals to 84,706. Step 2. Let's calculate the purchase price of the land. Total purchase price equals land plus building. Land value equals total purchase price minus building value. Land value equals 84,706 plus 180,000 equals 208,373. Question 9. Which of the following correctly lists assets from most liquid to least liquid? Correct answer, B. Marketable securities, accounts receivable, inventories, prepaid expenses. Explanation. Liquidity refers to how quickly and easily an asset can be converted into cash. The correct order from most liquid to least liquid is 1. Marketable securities. These are highly liquid and can quickly be converted into cash. 2. Accounts receivable. Money owed to the business that is expected to be collected soon, making it liquid but less so than marketable securities. 3. Inventories. Goods held for sale, which are less liquid since they need to be sold to generate cash. 4. Prepaid expenses. Payments made in advance for goods or services, which are the least liquid as they are considered already spent and cannot be converted to cash easily. Breakdown of other options. A. Accounts receivable. Inventories. Accounts payable. Marketable securities. Incorrect. Accounts payable is a liability, not an asset, and it should not be included in this list. C. Cash, accounts receivable, land, marketable securities. Incorrect. Land is less liquid than marketable securities, and cash should be listed first. D. Building, cash, prepaid expenses, inventories. Incorrect. The building is not liquid at all compared to other options. Question 10. Which of the following statements is true regarding sole proprietorships, partnerships, and corporations? Correct answer, D. A corporation is a separate legal entity with its own income tax status. Explanation. A corporation is considered a separate legal entity from its owners, shareholders, meaning it files its own income tax return and is taxed independently of its shareholders. Breakdown of other options. A. Only sole proprietors need to report business income on their personal income tax returns. Incorrect. Both sole proprietors and partners report business income on their personal tax returns. Corporations do not. B. Only partners of a partnership need to report business income on their personal tax returns. Incorrect. While partners report business income on their personal returns, sole proprietors do as well. Corporations report income separately. C. Sole proprietorships, partnerships, and corporations are identical in terms of taxation of owners' income. Incorrect. These entities are taxed differently. Sole proprietors and partners report income personally, while corporations are taxed separately. Question 11. Which one of the following is a liability on a financial statement? Correct answer, B. Mortgages payable. Explanation. A liability is a financial obligation or debt that a company owes. Mortgages payable refers to the amount the company owes on its mortgage, which is a liability on the balance sheet. Breakdown of other options. A. Accumulated depreciation. Incorrect. This is a contra asset account, which reduces the value of assets over time, but is not a liability. C. Wages paid. Incorrect. Wages paid are considered an expense and have already been accounted for when paid, so they are not listed as a liability at that point. D. Prepaid expense. Incorrect. Prepaid expenses represent a payment made in advance for goods or services to be received in the future and are listed as assets, not liabilities. Question 12. Which of the following statements regarding depreciation expense is true? Correct answer. B. It is an accounting concept that attempts to allocate the cost of an asset over the life of the asset. Explanation. Depreciation expense is an accounting method used to spread the cost of an asset over its useful life. This allows companies to match the cost of the asset to the revenue it generates during that period. Breakdown of other options. A. It is another name for capital cost allowance. Incorrect. Capital cost allowance, CCA, is specific to Canadian tax rules and is related to tax deductions, not depreciation in financial accounting. C. It is usually calculated on land by the straight line method. Incorrect. Land is not depreciated because it has an indefinite useful life. Depreciation typically applies to assets with a finite useful life, like buildings or equipment. D. It is the amount the Income Tax Act permits a taxpayer to deduct from income in determining taxable income. Incorrect. This statement refers to CCA in tax terms, not to depreciation expense, which is an accounting concept. Question 13. Which of the following statements regarding income statements is false? Answer, D. False statement. It is always determined on an annual basis. Explanation. An income statement is not always determined on an annual basis. It can be prepared for any period, e.g., monthly, quarterly, or annually, depending on the company's reporting cycle. Breakdown of other options. A. It is also known as a profit and loss statement. Correct. The income statement is often referred to as a profit and loss P&L statement, as it shows the company's revenues, costs, and profits over a specific period. B. It is a listing of the revenue and expenses of a business enterprise. Correct. The income statement lists the revenues and expenses, helping to determine the net income or loss of a business. C. It may include depreciation, revenue, and cost of goods sold. Correct. Depreciation, revenue, and cost of goods sold are typical items found on an income statement, helping to calculate profit or loss. Question 14. A company pays $97,835 for an asset on which the Income Tax Act allows capital cost allowance at 5% per year. The asset is expected to have a useful life of 25 years and will have no salvage value at the end of this time. Calculate the depreciation expense for accounting purposes for the asset's third year if the accountant chooses to use straight-line depreciation. Correct answer, B. $4,440.80. Explanation. To calculate straight-line depreciation, use the following formula. Depreciation expense equals cost of asset minus salvage value divided by useful life given. Cost of asset equals $97,835. Salvage value equals 0. Useful life equals 25 years. Depreciation expense equals to 97,835 minus 0 divided by 25 equals to 97,835 divided by 25, which equals to 3,913 per year. Since the depreciation is consistent each year under the straight line method, the depreciation expense for the third year is $3,940. Question 15. Which of the following would not be included in a statement of profit and loss? Correct answer, C. Current liabilities. Explanation. The statement of profit and loss, also known as the income statement, focuses on the revenues and expenses of a company, ultimately showing the net profit or loss. Depreciation, option A, is an expense and is included on the income statement as it reflects the allocation of the asset's cost over its useful life. Rental revenue, option B, is income generated by renting out property, and it is included in the profit and loss statement as part of revenue. Interest on mortgage, option D, is an expense related to the cost of borrowing money and is included in the income statement as part of finance expenses. Current liabilities, option C, on the other hand, are short-term obligations that the company owes and are listed on the balance sheet, not the profit and loss statement. Question 16. Which of the following is not a characteristic of a corporation? Correct answer, C. The shares of a corporation must be held by more than one party. Explanation. A corporation can have just one shareholder. In fact, many corporations are formed by a single individual, particularly in the case of sole proprietorships that are incorporated. There is no requirement that the shares of a corporation must be held by more than one party. A corporation can be sued. Option A, true. Corporations are legal entities that can sue and be sued in their own name. The shareholders of a corporation cannot be held responsible for more than their agreed share purchase. Option B, true. Shareholders' liability is generally limited to the amount they invested in the corporation, the value of the shares they own. A corporation is a taxable entity. Option D, true. A corporation is considered a separate legal entity and is taxed separately from its owners, shareholders. Question 17. Which of the following statements about depreciation expense is true? Correct answer, D. It is the method used to allocate the cost of an asset over time. Explanation. Depreciation is the process of allocating the cost of a tangible asset over its useful life. This allocation helps companies match the cost of an asset with the revenue it generates over time. It is another name for capital cost allowance. Option A, false. Capital cost allowance, CCA, is a specific term used in Canada for tax purposes related to the depreciation of capital assets, but it is not the same as general depreciation expense. It is a deductible expense in computing income for purposes of income taxation. Option B, false. Depreciation is deductible for tax purposes but is accounted for differently than CCA, which applies specific rules for taxation. It is usually calculated on land by the straight line method. Option C, false. Land is not depreciated because it does not lose value over time. Depreciation applies to tangible assets like buildings and machinery, not land. Question 18. Suppose XYZ Limited is located in a building that was purchased 2 years ago for $1 million. The building has an economic life of 10 years with no salvage value. Annual depreciation is calculated using the straight line method. If XYZ Limited earned a net income of $450,000 and claimed $38,400 of capital cost allowance in the second year, what is XYZ's taxable income at the end of year 2? Correct answer, $511,600. Explanation. Step 1. We need to find the annual depreciation expense. Since the building cost of $1 million and it has an economic life of 10 years, we use the straight line method to figure out how much depreciation applies each year. So we do. Annual depreciation expense equals cost of building divided by economic life, which is 1 million divided by 10. That equals to 100,000. Step 2. Let's find out the adjusted net income. We add the depreciation expense to the net income from the financial statements. So 450,000 plus 100,000 equals to 550,000. Step 3. Let's subtract capital cost allowance, CCA, 550,000 minus 38,400, which equals to 511,600. Our total taxable income equals to 511,600. Question 19. Which of the following would be classified as a current asset on the financial statements of a business? Correct answer, B. Rents receivable. Explanation. Rents receivable is a current asset because it represents amounts expected to be collected within the business's normal operating cycle or 1 year. Breakdown of other options. A. Land. Incorrect. Land is a non-current asset, not typically converted to cash within a year. C. Real property at its historic cost. Incorrect. This is a fixed, non-current asset reported on the balance sheet, not a current asset. D. Accounts payable. Incorrect. Accounts payable is a current liability, not an asset. Question 20. Which of the following options is inconsistent with generally accepted accounting principles? Correct answer, B. Assets are revalued upwards to account for the effect of inflation. Explanation. GAAP, generally accepted accounting principles, is built on principles such as historical cost, which requires assets to be recorded at their original purchase cost. Revaluing assets to account for inflation is not permitted because it violates the principle of reliability and consistency in financial reporting. Adjustments for inflation would make financial statements less comparable and subjective. Breakdown of other options. A. Expenses directly associated with particular revenues are recognized at the time they are incurred. This follows the matching principle, a key aspect of GAAP. Expenses are matched with revenues in the same reporting period to ensure accurate profit or loss calculation. C. Fiscal year ends cannot be changed at will. GAAP requires consistent reporting periods for comparability. Changing a fiscal year end requires justifiable reasons and approval, ensuring continuity and transparency in financial reporting. D. Revenues are recognized at the time they are earned. This is the revenue recognition principle, which ensures that revenues are reported in the period when the service is provided or the product is delivered, regardless of when the payment is received. Question 21. Which of the following is a current asset on the financial statement of a business? Correct answer, C. Marketable securities. Explanation. Marketable securities are considered current assets because they are liquid investments that can be quickly converted into cash, typically within 1 year. Examples include stocks, bonds, and treasury bills. Summary. Marketable securities are classified as current assets due to their liquidity and short-term nature, aligning them with other readily available resources like cash and accounts receivable. Breakdown of other options. A. Owner's initial investment. This is part of owner's equity, not an asset. It represents the funds contributed by the owner to start or maintain the business. B. Rents payable. This is a current liability, not an asset. It represents amounts the business owes for rent. D. Sales revenue. This is part of the income statement, not the balance sheet. It reflects the revenue generated from sales, not a tangible or liquid asset. Question 22. Which of the following is a liability on a financial statement? Correct answer, C. Salaries payable. Explanation. Liabilities are obligations owed by a business to external parties, typically settled through cash, goods, or services. Salaries payable is a current liability representing wages earned by employees that have not yet been paid. It appears on the balance sheet under current liabilities because it is expected to be settled within 1 year. Breakdown of other options. A. Depreciation expense. Incorrect. Depreciation expense is a non-cash expense reported on the income statement. It reflects the allocation of an asset's cost over its useful life, not a liability. B. Accumulated depreciation. Incorrect. This is a contra-asset account on the balance sheet that reduces the book value of long-term assets. It is not a liability. D. Interest expense. Incorrect. Interest expense is a cost for borrowing money reported on the income statement and does not represent an obligation outstanding on the balance sheet. Question 23. Which of the following is a liability on a financial statement? Correct answer, D. Accounts payable. Explanation. Liabilities are obligations a business owes to others. Accounts payable is a current liability that represents amounts owed to suppliers or creditors for goods and services received but not yet paid. It is listed on the balance sheet under liabilities. Breakdown of other options. A. Accumulated depreciation. Incorrect. This is a contra asset account that reduces the book value of an asset over time. It is not a liability. B. Inventory. Incorrect. Inventory is a current asset that represents goods held for sale, not a liability. Rent receivable. Incorrect. This is also a current asset reflecting rent owed to the business but not yet collected. Question 24. Retained earnings on a company's financial statements is best defined as which of the following? Correct answer. C. The accumulated total of the company's profits, less losses, less dividends since incorporation. Explanation. Retained earnings represent the portion of a company's net income that is not distributed as dividends but is reinvested into the business. Over time, retained earnings accumulate and reflect the company's total profits minus losses after dividends have been paid. Breakdown of other options. A. The company's profit for the current year. Incorrect. Retained earnings are cumulative, not just for the current year. B. The company's profit for the current year that was retained for future investment. Incorrect. Retained earnings encompass all retained profits since incorporation, not just the current year's profits. D. The accumulated profits since incorporation used for investing in fixed assets. Incorrect. Retained earnings can be used for any purpose, not exclusively for investing in fixed assets. Question 25. At the end of a profitable year, a business's ownership has decided to leave all these profits in the business. Which one of the following best describes the effect that profitable operations have on the balance sheet of a business? Correct answer. A. Owner's equity is increased. Explanation. When profits are retained in the business, they increase retained earnings, which is a component of owner's equity on the balance sheet. Profitable operations reflect the company's ability to generate income, which directly impacts equity when not distributed as dividends. Breakdown of other options. B. Assets are increased. Incorrect. While assets like cash may increase as a result of profits, this is not always the case. E.g., profits might be reinvested into other assets or used to pay liabilities. C. Cash is increased. Incorrect. Profits do not necessarily result in an increase in cash. They may be used in ways that do not affect cash balances, e.g., inventory purchases or debt repayment. D. Liabilities are decreased. Incorrect. Profitability does not automatically reduce liabilities, although retained profits can be used to pay down debt. Question 26. Freddie Mae Limited purchased a small commercial building for $225,000, of which $100,000 was the value of the land. Freddie, the company president, felt this was an excellent deal because he would have been willing to pay as much as $250,000. 1 year later, Freddie sold the property for $300,000. According to generally accepted accounting principles, at the time of purchase, the value of the building in the question above should be recorded on Freddie Mae Limited's balance sheet as which of the following? Correct answer. B. $225,000. Explanation. Under generally accepted accounting principles, GAAP, assets should be recorded at their cost at the time of acquisition. In this case, Freddie Mae Limited purchased the property for $225,000, so the value recorded for the building would be $225,000, which includes both the land and the building. The amount Freddie was willing to pay, or the sale price a year later, does not impact the initial recorded cost. Breakdown of other options. A. $125,000. Incorrect. This amount reflects the value of the land, not the total cost of the property. The total cost of the property, land plus building, should be recorded as $225,000. C. $250,000. Incorrect. This represents Freddie's personal opinion of the building's value, but under GAAP, the purchase price of $225,000 is the amount that should be recorded, not Freddie's perceived value. D. A value determined by an objective appraiser. Incorrect. While appraisals may be used for other purposes, e.g., for sale or insurance, GAAP requires that assets be recorded at their acquisition cost, not based on an appraised value at the time of purchase. Question 27. Consider an asset with a purchase price of $185,000, an economic life of 9 years, and a $5,000 salvage value. If you purchase the asset today, what will be its book value in 3 years? Correct answer, $125,000. Explanation. To calculate the book value of an asset after a certain number of years, you can use the straight-line depreciation method. The formula for annual depreciation is annual depreciation equals cost of the asset minus salvage value divided by economic life. Step 1. Let's calculate the annual depreciation. Annual depreciation equals to 185,000 minus 5,000 divided by 9, which equals to 180,000 divided by 9 equals $20,000. Step 2. Let's calculate the accumulated depreciation after 3 years. Accumulated depreciation of 3 years equals to 3 times 20,000 equals to $60,000. Step 3. Let's calculate the book value after 3 years. Book value equals cost of the asset minus accumulated depreciation. Book value equals to 185,000 minus 60,000 equals to 125,000. Question 28. Which of the following statements regarding capital cost allowance CCA is false? C is false statement. The maximum CCA in a given year is equal to the depreciation expense multiplied by the CCA percentage. Explanation. The maximum CCA that can be claimed is not simply the depreciation expense multiplied by the CCA percentage. Instead, it is based on the asset's undepreciated capital cost, UCC, at the beginning of the year and the applicable CCA class rate. The CCA rate is applied to the UCC, not to the depreciation expense. Breakdown of other options. A. Correct. In the year an asset is purchased, only half of the maximum allowable CCA can be claimed, as part of the half-year rule. B. Correct. No CCA can be claimed in the year of disposal because the asset is no longer part of the business. D. Correct. The Canada Revenue Agency, CRA, determines the CCA percentage rate for different classes of assets. Question 29. Which of the following would generally not be found in the current liabilities section of a balance sheet? Correct answer, D. Rent receivable. Explanation. Rent receivable is an asset, not a liability. It represents the amount of rent a business expects to collect, and therefore it would be found in the current assets section of the balance sheet. Breakdown of other options. Correct. The current portion of long-term debt is part of current liabilities because it represents the portion of long-term debt due within the next year. B. Correct. Property taxes payable is a current liability as it is an obligation due in the near term. C. Correct. Income taxes payable is a current liability because it represents taxes owed to the government that are due within the year. Question 30. Which one of the following is not a depreciable asset? Correct answer, B. 50 acres of land. Explanation. Land is not a depreciable asset because it does not lose value over time due to wear and tear or obsolescence. Land typically appreciates in value, which is why it is excluded from depreciation. Breakdown of other options. A. Septic tank system. Depreciable, as it is a fixed asset that deteriorates over time and has a limited useful life. C. Carpeting. Depreciable, as it wears out over time and must be replaced periodically. D. Concrete patio. Depreciable, as it is a physical asset that deteriorates over time and has a limited useful life. Question 31. Question. Which of the following statements regarding depreciation expense is true? Correct answer. B. It is an accounting concept that attempts to allocate the cost of an asset over its useful life. Explanation. Depreciation expense is an accounting method used to systematically allocate the cost of a tangible asset over its useful life. This reflects the consumption or usage of the asset during the accounting period. Breakdown of other options. A. It is another name for capital cost allowance. Incorrect. Capital cost allowance, CCA, is a tax-specific concept in Canada, while depreciation is an accounting concept. It is usually calculated on land by the straight-line method. Incorrect. Land is not depreciable as it does not wear out or lose value due to usage. D. It is never permitted on a single-family residence. Incorrect. Depreciation may apply to rental properties, including single-family residences, if used to generate income. Question 32. Which of the following options is a current asset on the balance sheet? Correct answer, D. Rent receivable. Explanation. A current asset is an asset expected to be converted into cash, sold, or consumed within 1 year. Rent receivable represents amounts owed to the business for rent that has not yet been paid, making it a current asset. Breakdown of other options. A. The owner's initial investment. Incorrect. This is part of owner's equity, not an asset. B. Rent payable. Incorrect. This is a liability, not an asset, as it represents amounts owed by the business. Real property at its historic cost. Incorrect. Real property is a fixed asset, not a current asset. Question 33. Which of the following statements regarding trusts and real estate investment trusts, REITs, is false? Correct answer, B. Income earned by a family trust is taxed at the tax rate of the youngest beneficiary. Explanation. Income earned by a family trust is not automatically taxed at the tax rate of the youngest beneficiary. Instead, the trust has the discretion to allocate income to beneficiaries, and taxes are calculated based on the beneficiaries' respective tax brackets. Breakdown of other options. A. Beneficial owners are liable only for the amount committed to the purchase of the trust units. Correct. Liability is typically limited to the investment in trust units. C. Family trusts allow a parent to deposit assets with a trustee and distribute the income to other members of the family. Correct. This is a common purpose of family trusts. D. Mortgage trusts and equity trusts are two types of REITs. Correct. These are standard classifications within REITs based on their investment focus. Question 34. ABC Inc. paid $155,000 for an asset on which the Income Tax Act allows capital cost allowance, CCA. The asset was purchased 5 years ago and will be disposed of at the end of this year. How much CCA will be claimed by ABC Inc. at the end of this year? Correct answer, C, $0. Explanation. Under the Income Tax Act, no CCA can be claimed in the year of disposal of an asset. This rule prevents double dipping, ensuring that businesses do not claim CCA and simultaneously deduct a loss or gain on disposal. Key point. While CCA is typically calculated annually based on the asset's undepreciated capital cost, UCC, the year of disposal is an exception to this rule. Question 35. In the case of a proprietorship, which one of the following accounts represents the link between the income statement and the balance sheet? Correct answer, A. Net income. Explanation. In a proprietorship, net income from the income statement flows into the owner's equity section on the balance sheet. It represents the earnings retained in the business after all expenses, which directly impacts the balance sheet by increasing the owner's equity. Breakdown of other options. B. Net assets. Incorrect. This term refers to the difference between assets and liabilities, but doesn't specifically link the income statement to the balance sheet. C. Depreciation expense. Incorrect. Depreciation is an expense reported on the income statement and reduces net income, but is not the direct link. D. Retained earnings. Incorrect. Proprietorships don't use retained earnings, as this is specific to corporations. For proprietors, the equivalent is the owner's capital account. Question 36. The book value of an asset can be best defined as which of the following? Correct answer, A. The purchase price of that asset less any depreciation taken to date. Explanation. The book value represents the asset's original cost reduced by the total depreciation charged over time. This is the value recorded on the balance sheet and reflects the asset's adjusted value based on usage or wear. Breakdown of other options. B. The price for which a similar asset could currently be purchased. Incorrect. This describes the market value, not the book value. C. The price at which the asset could be sold. Incorrect. This represents the asset's fair market or sale value. D. A value subjectively arrived at by an appraiser. Incorrect. This would be an appraised value, not the book value. Question 37. Yuppie is the sole proprietor of the Mountain Bike Emporium. On her balance sheet as of December 31st, 20XX, total assets were $185,900. If the only liabilities were accounts payable of $2,900 and long-term debt of $89,450, what is the amount of owner's equity? Miss Yuppie, capital account. Correct answer, A, $93,550. Explanation. Owner's equity is calculated using the accounting equation. Owner's equity equals total assets minus total liabilities. Steps 1. Total liabilities equals accounts payable plus long-term debt in this scenario. Total liabilities equals $2,900 plus $89,450 equals to $92,350. Step 2. Owner's equity equals total assets minus total liabilities. Owner's equity equals $185,900 minus $92,350, which equals to $93,550. Thus, Miss Yuppie's capital account is $93,550. Question 38. Which one of the following is false with respect to the proprietorship form of business? Answer. C is a false statement. The proprietor is liable for all debts of their business to the extent of their capital investment in the business only. Explanation. In a proprietorship, the owner is personally liable for all debts of the business. not limited to their capital investment. Their personal assets can also be used to satisfy business debts. Statements A, B, and D are true. A. The business ceases to exist upon the death of the owner. B. Business income is taxed at the owner's personal tax rates. D. There is no legal distinction between the business and the owner. Thus, the statement in C is false because a proprietor's liability is unlimited, not restricted to their capital investment. Question 39. Which of the following is not a commonly used financial statement? Correct. Answer: D. A corporate statement of holdings. Explanation: A. Statement of profit and loss is another term for an income statement, commonly used in financial reporting. B. Income statement is a standard financial statement showing revenues, expenses, and profits over a specific period. C. Balance sheet summarizes a company's financial position by listing its assets, liabilities, and equity at a given time. D. Corporate statement of holdings is not a standard financial statement. It is not commonly used or recognized in financial reporting practices. Question 40. Arco Architects recently purchased $19,000 worth of new office furniture, but with their quantity discount, the final cost was only $17,100. It is expected that the furniture can be sold at the end of its 10-year life for $1,500. What is the annual depreciation expense if Arco uses the straight-line method? Solution: we will need to use the formula for straight-line depreciation. Annual depreciation expense equals cost minus salvage value divided by useful life. Step 2. Plug in the values. Cost equals $7,100, salvage value equals $1,500, useful life equals 10 years. Therefore, annual depreciation expense equals $17,100 minus $1,500 divided by 10. Annual depreciation expense equals $15,600 divided by 10, which equals to $1,560. Correct answer B, $1,560. Explanation: the straight-line method spreads the depreciable amount, cost minus salvage value, evenly over the asset's useful life. The quantity discount is already factored into the purchase price of $17,100, so the annual depreciation is calculated based on this amount. Question 41. An investment corporation purchased an apartment building on March 31, 2011 for $2,800,000. Of that amount, $1,700,000 was attributed to the building and $1,100,000 to the land. Depreciation was claimed at $50,000 per year for the life of the building. The building component of the property was valued on March 31, 2021 at $2,400,000. What would be the net amount of the building appearing on the corporation's statement of assets and liabilities as of March 31, 2021? Correct answer: B, $1,200,000. Solution: Step 1. Determine the total depreciation over 10 years. Depreciation per year equals $50,000. Time equals March 31, 2011 to March 31, 2021, which is 10 years. Total depreciation equals 50,000 times 10 equals 500,000. Step 2. Calculate the net book value. Net book value equals original building value minus total depreciation. Net book value equals $1,700,000 minus $500,000 equals $1,200,000. Step 3. Consider the valuation update. The valuation of $2,400,000 on March 31, 2021 is irrelevant for the statement of assets and liabilities, as GAAP typically does not allow upward revaluation for depreciation purposes. Explanation: the net book value is determined by subtracting accumulated depreciation from the original value of the building. The market value increase is not reflected in the financial statements under generally accepted accounting principles, GAAP. Question 42. A company has just bought a truck for $22,500. It is expected that the truck can be sold for $3,000 15 years from now. The current market value of the vehicle is $27,000. Using the straight-line method, what is the annual depreciation expense? Solution: Step 1. Straight-line depreciation formula. Annual depreciation expense equals purchase price minus salvage value divided by useful life. Step 2. Substitute the given values. Purchase price equals $22,500. Salvage value equals $3,000. Useful life equals 15 years. Annual depreciation expense equals 22,500 minus 3,000 divided by 15. Step 3. Calculate. Annual depreciation expense equals 19,500 divided by 15 equals 1,300. Correct answer A, $1,300. Explanation. The market value of $27,000 is irrelevant for calculating depreciation. Only the purchase price, salvage value, and useful life are considered. Question 43. Which one of the following types of organization is a separate taxable entity? Correct answer D, a corporation. Explanation. A corporation is a separate legal and taxable entity. It files its own tax return and pays taxes at corporate rates. Other options. General partnership. Partners report their share of income on personal tax returns, not a separate taxable entity. Sole proprietorship. The owner and the business are the same legal entity, and income is taxed at the owner's personal rate, not a separate taxable entity. Limited partnership. Income is passed through to the partners who report it on their personal tax returns, not a separate taxable entity. Question 44. Relax Realty Inc. has ended the current year with a net income of $234,000. During the year, Relax issued $14,000 in dividends, incurred $112 of operating expenses, and paid $15,000 in taxes. Which of the following most likely occurred on Relax's balance sheet? Correct answer D. Retained earnings increased by $220,000. Solution. 1. Net income and retained earnings relationship. Net income contributes to retained earnings after dividends are paid. Retained earnings equals net income minus dividends. Calculation. Retained earnings increase equals $234,000 minus $14,000 equals $220,000. 2. Analysis of options. A. Owner's equity increased by $234,000. This assumes no dividends were issued, which is incorrect. B. Revenue decreased by $14,000. Dividends do not reduce revenue, they reduce retained earnings. C. Net income increased by $234,000. Net income is a figure from the income statement, not a balance sheet effect. D. Retained earnings increased by $220,000. This correctly reflects the increase after deducting dividends from net income. Question 45. A statement of profit and loss measures which of the following? Correct answer. B. Revenues and expenses for a certain period of time. Explanation. A statement of profit and loss, also known as an income statement, summarizes the revenues and expenses of a business over a specific period of time, e.g., a quarter or a year. It determines the net profit or loss for that period. Other options. Incorrect. The statement does not measure asset acquisition. This is captured on the balance sheet. B. Correct. The statement tracks revenues and expenses over a defined period. Incorrect. The statement covers a time period, not a single point in time. D. Incorrect. Assets and liabilities are measured on the balance sheet at a specific point in time. Question 46. The practice of recognizing expenses as they are incurred, rather than when they are paid for, is a characteristic of which generally accepted accounting principle? Correct answer, C. The matching principle. Explanation. The matching principle is a generally accepted accounting principle, GAAP, that requires expenses to be recorded in the same accounting period as the revenues they help to generate. This principle ensures that income statements reflect accurate profitability for a specific period. Other options. A. The cost principle. Incorrect. The cost principle states that assets should be recorded at their historical cost, not related to expenses. B. The recognition principle. Incorrect. The recognition principle recognizes revenues when they are earned. C. The matching principle. Correct. The matching principle matches expenses with the revenues they are associated with, regardless of when payment is made. D. The conservation principle. Incorrect. The conservation principle involves reporting estimates conservatively to avoid overstatement of assets or income. Question 47. A company pays $97,630 for an asset on which the Income Tax Act allows capital cost allowance at 5% per year. The asset is expected to have a useful life of 25 years and will have no salvage value at the end of this time. Calculate the depreciation expense for accounting purposes for the asset's third year if the accountant chooses to use straight-line depreciation. Solution. Step 1. Use the straight-line depreciation formula. Annual depreciation expense equals cost of asset minus salvage value divided by useful life. Annual depreciation expense equals 97,635 minus 0 divided by 25 equals 3,905.40. Step 2. Depreciation expense for year 3. Since straight-line depreciation charges the same amount each year, the depreciation expense for the third year is $3,905.40. So the correct answer is D, 3,905.40. Question 48. This financial statement of Ambleside Productions Ltd. is known as which of the following? Answer: C, a balance sheet. Explanation: the financial statement provided is a balance sheet because it shows the company's assets, liabilities, and shareholders' equity at a specific point in time, March 31st, 2026. Question 49. Which of the following statements regarding limited partnerships is true? Correct answer: D, there must be one or more general partners. Explanation: A, false. Limited partners are only liable to the extent of their capital contributions, not for all partnership debts. General partners bear unlimited liability. B, false. Limited partners cannot actively manage the business. If they do, they risk losing their limited liability status. C, false. Income in a limited partnership is not taxed at the partnership level. Instead, it is distributed to the partners, who are taxed individually. D, true. A limited partnership must have at least one general partner who is responsible for managing the business and assumes unlimited liability. Question 50. Which of the following options is true regarding the final value shown on a proprietor's income statement? Correct answer: D, it is known as net income. Explanation: the final value on a proprietor's income statement is called net income, which represents the profit after all expenses have been subtracted from revenues. Other options: A, incorrect. Retained earnings appear on the balance sheet, not the income statement. B, incorrect. Taxable income plus depreciation is not how the final value of the income statement is calculated. C, incorrect. The income statement reflects the difference between revenues and expenses, not liabilities. Question 51. Which one of the following is the generally accepted accounting principle that determines what amount will be recorded on the company's balance sheet as the value of a building at the time of purchase? Correct answer: D, the cost principle. Explanation: the cost principle states that assets should be recorded at their original cost at the time of purchase, which is the value that will be recorded on the balance sheet. Other options: A, incorrect. The objectivity principle relates to ensuring that financial statements are based on verifiable data, not the method of recording asset value. B, incorrect. The consistency principle requires consistent application of accounting methods over time, but it does not determine the value of assets at purchase. C, incorrect. The revenue recognition principle concerns when revenue is recognized, not how assets are valued on the balance sheet. Question 52. The subject clauses have just been removed from a contract of purchase and sale, but the sale will not complete for another 17 days. Sandy salesperson has already recorded the commission from the sale as income. Which of the generally accepted accounting principles, GAAP, was she following? Correct answer: D, the revenue recognition principle. Explanation: the revenue recognition principle states that revenue should be recognized when it is earned, regardless of when payment is received. In this case, Sandy recorded the commission as income when the contract conditions were met, i.e., when the subject clauses were removed, even though the sale has not yet completed. Other options: A, incorrect. The matching principle involves matching expenses to the revenues they help generate, not the timing of revenue recognition. Incorrect. The cost principle deals with recording assets at their original cost, not with revenue recognition. C, incorrect. The consistency principle requires consistent accounting methods over time, but doesn't dictate when revenue should be recognized. Question 53. The principle of unlimited liability implies which of the following? Correct answer: C, that an owner may lose more money than their initial investment. Explanation: the principle of unlimited liability means that the owner of a business, such as a sole proprietor or general partner, is personally responsible for all of the business's debts and obligations. This means they could lose more than their initial investment, potentially even personal assets. Other options: A, incorrect. While unlimited liability means personal responsibility for debts, it doesn't necessarily imply an unmanageable or unsolvable debt load. B. Incorrect. While unlimited liability applies to general partners, it's not a reason to avoid becoming one. It's a characteristic of the role, not an advisory statement. D. Incorrect. There is a significant difference between a sole proprietor with unlimited liability and a shareholder in a corporation who typically has limited liability. Question 54. Which of the following statements regarding generally accepted accounting principles is false? Answer. C. Assets are recorded at fair market value when they are acquired. This is a false statement. Explanation. According to generally accepted accounting principles, GAAP, assets are recorded at their cost, purchase price, not their fair market value. The fair market value may be considered for revaluation under certain circumstances, but this is not the usual treatment for asset acquisition. Other options. A. Correct. Revenues are recognized when earned, according to the revenue recognition principle, even if cash has not yet been received. B. Correct. Fiscal year ends must follow certain rules, and businesses cannot change the fiscal year end arbitrarily without following proper procedures. D. Correct. Expenses are recorded when they are incurred, in line with the matching principle, which matches expenses to the revenues they help generate. Question 55. Which of the following statements is true when calculating income taxes payable for a corporation? Correct answer. B. Capital cost allowance cannot be treated as a deductible expense. Explanation. Capital cost allowance, CCA, is a method used in Canada to calculate the depreciation of assets for tax purposes. It is indeed treated as a deductible expense when calculating taxable income for corporations, but the amount depends on the asset's classification and the applicable CCA rate. Other options. A. Incorrect. Depreciation expense can be treated as a deductible expense, but it is calculated differently for tax purposes using capital cost allowance rather than the straight line or other depreciation methods used for accounting. C. Incorrect. The computation of taxable income is essential in determining the income tax payable, as tax is calculated based on the taxable income. D. Incorrect. The amount of declared dividends is not directly relevant for calculating income taxes payable, as taxes are based on taxable income, not dividends.